Ryan, how are you, mate? There's been a fair bit going on. It's and a week or so since we've chatted, so there's a lot to talk about.
Yeah, a lot of volatility and fear out there at the moment. This past week, a lot of China talk and things, and it seems to have had a bit of an impact on a few of our investments. So I think it'll be good to have a chat about that today.
Yeah, I think. I mean, what I think is important in times like this is to put things into perspective, right? I mean, we've had a market that's going up, or that has been going up for the past 18 months, and any type of pullback or anything like that tends to get met with maybe a little bit too much fear. So I wrote a note to subscribers of my investment advisory earlier today and said, the main thing is not to panic as long as you've got, your portfolio reasonably diversified, all those sorts of things, and not in those danger areas like iron ore. I think you're going to be reasonably okay. But for today's chat, we wanted to just go through the portfolio as we've put a few investment recommendations out over the past few months just to review those. And I guess it's a good time to do it because we have seen some volatility in the Bitcoin price overnight. And we were speculating earlier whether that did have something to do with the Chinese situation. So maybe we could talk about that. What's happening with Bitcoin?
Yeah, so the Bitcoin price has fallen pretty hard in the last few days. If you recall, I think last time we chatted, it had a bit of a dip on the El Salvador news, and we sort of suggested maybe that was a little bit manipulated. Things were starting to look all right on my pricing signals until yesterday or the day before, I think, and there was another steep plummet, and it's fallen about 10%, 11% in the last 24 hours, which is quite a hefty amount for a one day. But
in saying that, reasonably standard for Bitcoin too, right?
You've always got to look at it in the crypto lens. It's big for crypto, but you still shrug off 10% moves in a day sometimes in crypto to an extent. But that has changed the dynamics of the price chart. The price chart is certainly looking weaker now. And I think what's happening is that basically this Evergrande news in China, there's a lot of sort of talk about credit contagion, and it's all this big picture macro stuff is feeding into the fear. It was all over the headlines yesterday in Australia, even. The Australian stock market sold off. The US stock market's been down for the last 3 weeks, and that had another big sell-off last week. And I think that fed into this general feeling of fear. But like you said, we've had a huge run up in all sorts of asset classes, including Bitcoin. You've got to expect pullbacks from time to time. It seems that the narrative seems to push fear a lot more than it used to. And so you've had a bit of panic selling in Bitcoin. I think that relates to the last time there was a big macro sell-off was March 2020 when the COVID crisis hit. And so Bitcoin sold off really steeply then. And that was basically because everyone was scared the world was going to collapse and grind to a standstill with lockdowns. And so I think people are remembering that and are maybe correlating that. But you've got to remember that was when Bitcoin was at $10,000 and it fell to $3,500 at one stage. Whereas this time we're at 55 a few weeks ago. Now we're at 40. The thing to remember here is now look at on-chain analysis signals as well. From looking at that, there is still Bitcoin moving off exchange addresses, which suggests that there's people coming in, buying these dips and just moving it into their own wallets, which would suggest it's not traders. It would suggest it's more investors with some sort of time horizon, because if you're trading, you usually keep your Bitcoin on an exchange because you want to get in and out fast. If you're moving it off an exchange, it suggests you're holding it in cold storage. So it seems to me that nothing's really changed with Bitcoin. There are buyers there, and they're not trying to do it all at once. They're doing pretty much what we suggested with Bitcoin, which is the dollar cost average in, keep buying through the highs and lows. And I had a quick look at the chart. I think when we first suggested buying Bitcoin, the price of Bitcoin was around about $50,000 US. And then since then it's fallen to 30,000, and now we're back at 40,000. So roughly speaking, if you were dollar cost averaging into Bitcoin throughout that time, right now you might be about break even. And that's the beauty of dollar cost averaging. You're not trying to pick a perfect time. You're actually just using the volatility to your advantage, because if you're buying in today, you're buying more Bitcoin than you were, say, 2 months ago. So I think the strategy still holds. And I think dollar cost averaging into Bitcoin until the end of the year, no matter what happens, is still a smart strategy. So whatever size you want to build into your portfolio of Bitcoin, try and do it through to the end of 2021 at least, or even the first, few months of 2022, and get your full allocation in that time. I think that's a good idea.
I was going to say, and just to remind people of the context of why we're making this recommendation to dollar cost average, it's to build a stake in the new digital economy that is going to, or what we see is going to be a feature of, I guess, the global monetary system in the next 5 or 10 years. So it's not really about what's happening next month or the month after. We obviously like to follow the price and to try to work out why the price is doing whatever it's doing. But the main strategy is the dollar cost averaging strategy over a number of months, whether it's 12 months or 24 months or whatever. But it's about building that position for the next 5 to 10 years, right?
Exactly. This is a long-term thing. Michael Saylor, the CEO of MicroStrategy, did a good analogy recently. He said, "Look, you're buying digital blocks of land. That's one analogy you can use with Bitcoin. And there's only ever going to be 21 million of these blocks of land, and you know that." This scarce digital land is going to be viable at some point in the future. It'd be analogous to going to New York and seeing all this land 200 years ago and saying, well, I know this is going to be viable at some point. What would you do? You wouldn't worry about the short-term speculation. You would just have a strategy to keep buying up your stake. And Bitcoin's sort of the way that works. You've got to look at where we've come from. We've had a country make this legal tender. We've had a nation state make Bitcoin legal tender. We've got actual corporations, listed corporations in America, putting this on their balance sheet. We've got Bitcoin miners coming up all over the place in more legitimate countries like America and in Europe and things like that. This thing is being legitimized. Even Fidelity, who are a huge fund manager, they manage like $10 trillion or something like that. They put out a report recently that said they can see the price of Bitcoin hitting $1 billion. I don't think even we have put out as outrageous.
It's optimistic.
But it sounds optimistic, but I think it was by 2038 or something like that. But they were looking at basically the supply, the predictable supply, and the adoption curve, and they used an analogy with something like smartphones or the internet. And they said, well, if we get that adoption rate, plus we know what the supply curve of Bitcoin is because it's pre-programmed, and if Bitcoin follows that adoption curve, then this is their model said that's a natural end point. So I don't know if we'll hit that or not, but you can imagine if it is a success, if the world at some point decides that censorship-free, manipulation-free money is the next form of money we want to get to, then these outrageous figures will seem realistic. The path of getting there is going to be volatile, and the key, what I've realized in my years in crypto, the key is to not get shaken out by the volatility, just to persist with it no matter what happens. And the volatility can be steep and it can make you question your assumptions, but how you deal with that is you've decided up front how much you're willing to risk. After that, it's just persisting with it, learning as much as you can, getting through these volatile times. So, and look, $40,000 of Bitcoin would have seemed outrageous 12 months ago. And yet now people are panicking at it. It doesn't really make sense, but that's the market for you.
Exactly. We'll talk a little bit more about Bitcoin when we discuss the Bitcoin miners in a moment. But one of the other recommendations we made earlier on in the service was gold, which is obviously a little bit different. It's not part of the digital economy, but certainly does have its place in terms of, I guess, a little bit of protection from this breakdown of the monetary system that we've been talking about. Similar situation, gold really hasn't done too much since we talked about it, or since we first recommended it. It's probably gone back a little bit, and that too has suffered a little bit of selling over the past month or so, or month or two, additional selling after it looked like it might have been turning back around. Personally, I put that down to some of the stresses that you were seeing in the Chinese credit system. Some of the studies that I've done on gold suggest it is used as a form of collateral, so it can be sold into the market or swapped into the market for US dollars when there's stresses in the system. Is there anything in particular that you're sort of seeing with gold that would make you think that that it's not sort of doing its job?
No, to me, and maybe this is just through the crypto lens, it's holding up okay between sort of $1,700 US and $1,900 US. And if you zoom out on the chart and you look at the monthly chart, it's still a decent uptrend from where it was, a few years back. So to me, it could be a period of consolidation. And where it fits in the global monetary system, though, yeah, it is already an established part. So I think where it goes next might depend on what the Fed decides to do with bond buying and how that affects interest rates. If that continues, I think gold store of value narrative looks more attractive in a world with more credit and low interest rates. The other thing I'm always conscious of, and I think we'll probably talk about this in the months ahead, is a lot of governments own gold. And if governments around the world realize the credit-based monetary system is collapsing, they may look to incorporate gold into some sort of central bank digital currency. It's an idea I've just started thinking about, recently when we started this service. But the more I think about it, the more I think they might try and tie in gold, because a lot of the major powers have that gold supply. So for them, it gives them an advantage. So it'll be interesting to see how that pays off, and something we can sort of research and talk about in the months ahead, I think.
Yeah, it'd certainly be interesting, because my view is that although central banks do hold a lot of gold, they've actually lent a lot of that gold out into the market. So whether they have to buy it back first or not is another question. I mean, it just goes to show the complexity of the market. And one of the distinctions we have made in the past is that gold has been a part of the traditional financial system for many years and is bound up in that system, whereas crypto sits outside of it, which is one of its advantages. Want to talk about the stablecoin strategy now. We obviously talked about that in the early stages as a way to gain income from stablecoins. And when we first discussed it, the yield on those stablecoins was quite high, and then it came down as the Bitcoin price came down. How is it looking now, that strategy, just in terms of the income it's generating?
Yeah, so just to recap, the stablecoin yield strategy is basically investing in the digital equivalent, a crypto equivalent of the US dollars, essentially. And on that note, the two stable coins we recommended were USDC and DAI, which is DAI, and they've both held their peg really well. So that risk has been fine. In terms of yield, we had a little bit of a rise recently when crypto was starting to look up a bit, and we got close to 7% yield. It's fallen back to about 4% or just under 4% today. Yep. But that's not too bad. I know we can't compare directly to a bank account because it's not apples with apples, but it's still a pretty decent yield. And the way I think of that, especially as Australians, is it's a nice little yield generating hedge to the potential of Australian dollar falling. So if, for example, these global ructions are real, and I don't think they are, to be honest, I think it's short-term panic, but if they are real and if there is a contagion, then the Aussie dollar will plummet and everyone will move to the US dollar. That tends to be what happens every panic. And so the stablecoin yield, as well as generating some nice interest, could be a nice little hedge.
It's an asset hedge as well.
Yeah, stable US dollars, just like having a US bank account almost. So it's working fine. If it keeps between 4% and 7%, I'll be happy. I've got quite a bit. No, I've got a little bit of money invested in it, and I'm happy with earning some money on that stash. It's retaining its peg. There's the only thing sort of on the horizon to keep an eye on, and something I'm keeping an eye on, is regulation of stablecoins. That's been mentioned a few times in the past, and the reason I specifically chose the USDC stablecoin is that they have taken a regulatory first approach. They've got partnerships with Visa or MasterCard, I can't remember which one, but they're a US entity. They make a big show of being part of the regulated system in America. And the other one, DAI, is actually the opposite. It's completely in the crypto world where no one can really do anything about it. It's created by people locking up cryptocurrencies, over collateralizing, and then creating DAI, which is ultimately backed by the value of those cryptos. And so, to my mind, they're two of the safer stable coins. There are other stable coins out there, and if I come across any that I think are offering decent high yields and are still fairly safe, then we can add them at a later point. But for now, I think those two earning 4 to 7% over time, in US dollars is a pretty decent addition to the overall portfolio.
I hope you enjoyed that preview from New Money Investor. To get access to the full video and much more, please click on the link below.